Good afternoon, ladies and gentlemen, and welcome to the Value and Index Property Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Sarah Martin. Sarah, good afternoon.
Good afternoon, everyone, and thank you for attending our first Investor Meet presentation. I'll introduce myself. I'm a chartered surveyor and I've been with Olin Property for the past 7 years. In a previous life, I was with King Sturgeon JLL in the capital markets team.
Good afternoon, I'm Louise Cleary, Managing Director of Olin Property. I'm a chartered surveyor and have been with the company for 16 years, and before that with Hermes Real Estate Investment for 7 years, and prior to that Land Securities for just under 3 years.
Good afternoon, I'm Matthew Oakeshott. I am the founder and chairman of Olim Property, the fund managers for VIP. I'm the O of Olim. Previously, I started in the city. I was director of Warburg Investment Management, now BlackRock, and then I ran Courtaulds Pension Fund, one of the big self-administered funds, before founding Olim in 1986, and I've been manager or co-manager of the property portfolio of VIP since then. Olin Property itself, you've met my two colleagues, there are 7 of us all together. We have 155 years of experience working together at Olin, so that's 22 years each, and we're great believers in continuity, both of our staff and of our advisors, like solicitors, managing agents, and so on. We are regulated by the Financial Conduct Authority as a property investment manager. We have about 700 million under management altogether. VIP, which was one of our very first clients and has grown from 8 million when we started to 130 million today. We have another investment trust, 2 Oxford colleges, and one of the largest FTSE 100 pension funds we run a portfolio for, which again we've had since 1987 in this case.
I'll now talk us through the portfolio's recent performance highlights. So here are the highlights from last year, from the annual report to the 31st of March 25. We entered the UK REIT regime on the 1st of April in order to protect the long-standing dividend policy. The share price was up 6.9% over the year, giving a share price total return of 15% and a net asset value total return of 7.1%. On a property level, our total return was 9%, which was well ahead of our benchmark, the MSCI Quarterly Property Index, at 6.3%. Now for the highlights for the half year to 30th of September. All our properties are now freehold since we sold our last long leasehold property in Doncaster in April. We completed a break removal and lease extension agreement on a Premier Inn hotel in Catterick, which we'll talk about later. 100% of our energy performance certificates are category A to C, in line with current minimum energy efficiency standards. We've carried out 13 rent reviews in the 6 months, adding £500,000 to the income. We've sold 4 properties at valuation for £13 million. We took out a new £15 million revolving credit facility with Handelsbanken to cover possible cash needs for the tender offer. And we also paid off a £15 million loan to Santander, which was expiring in March 26. So in summary, over the 6 months, we have total property return has been 2.5%, which is made up of an income return of 3.2% and a slight capital decline of 0.6%, a share price total return of 14%, a dividend yield of 6.8%, and the share price increased 12% over the 6 months.
Our long-term property portfolio performance record here for VIP is public. We've been publishing it every year since 1986 when we started. And you can see that we have consistently over medium, short and longer periods outperformed both our benchmark of the MSCI Property Index, usually by between 2 and 3%, but just over 3% in the very long term. But equally important, we've also produced real returns significantly above the retail price index. So those real returns you'll see looking at the yellow bars have tended to be around about 4% real above the retail price index over the longer period. Our property portfolio, we'll talk a bit later about how we achieve these consistent record, but our portfolio tends to outperform the index. It's quite defensive. It tends to outperform the index, particularly when the index is dull. We lag behind a little bit in raging bull markets, but we tend to more than catch up for that when things are quieter. Now, the dividend is the most important single reason people, we believe, hold the shares, and the record is, again, very consistent over the whole 38 years. We're what's called by the Association of Investment Companies, and we've just switched to being a REIT, but we have been an investment company for many years. We're one of their dividend heroes because one of the few companies that's put the dividend up every year for the last 38 years. We have done that. We believe both large and small shareholders, it really matters to them. And the total dividend per share is up by just over 1,000%, 6.5% a year since we've been running the portfolio, compared to 293% for the RPI. That's 6.5% a year compound. Plays 3.7%. And again, if you just look at the chart here, you'll see consistent dividend history. We had some very rapid growth early on when it wasn't so much indexed, and it's been a consistent pattern of growth since.
Now Louise and I will run through some specifics of the portfolio. So here's a summary of the portfolio with a comparison to the end of the last financial year. So following the sales, the net initial yield is up from 6.3% to 6.5%, and the portfolio's WAULT, which is the weighted unexpired lease term, is up over the 6 months to 13.5 years to first break. Our average lot size is now 5.1 million. So the key metrics of our portfolio are that all our rent reviews are 100% linked to inflation or fixed increases. We continue to collect 100% of the rent, and there are no voids across the portfolio, which compares favourably to the MSCI index, which has a 9% vacancy rate. Our average lease length is now 13.5 years to break and 15.1 to expiry, again in excess of the MSCI index. We have 26 properties with 28 leases.
Index-related rent review pattern. 100% of the income is now index-related, 86% RPI linked, 11% CPI, and 3% have fixed increases. The majority of the leases have caps and collars. We have 4 properties that have 5-yearly uncapped RPI reviews, and we no longer have any properties with open market rent reviews. So as at the end of March 25, collared uplifts average 1.6% per annum and capped uplifts 3.8% across the portfolio. It's going on to next slide, high quality tenants. 82% of income from the top 10. So this is a snapshot of the high quality, strong tenants within the portfolio which speak for themselves. We probably have the best in the REIT sector, we think, with 82% of the income coming from 10 companies. Strong, sustainable income. The portfolio, as said before, is 100% let with a current contracted income of 9.2 million. We have a diversified, high quality, strong tenant base with 17 different covenants across England and Scotland, with the top tenants representing 82% of the sustainable income with 19 tenancies. 7 companies make up the balance of the 18%. You may have seen in the news our smallest tenant by income, Pete the Pizza Hut, have entered administration. However, the unit in Coventry has not been affected as it's about to be assigned to Yum, who have a market capitalisation of $41 billion, and there has been no rent loss. Impact of inflation on future rental growth. So this slide shows the impact of inflation on the portfolio's future annual rental growth over a 5-year period. It shows how fast income grows over differing inflation assumptions. So each of the red bars shows a 5-year period of annual rental growth from 2025 and how fast the income will grow annually according to a differing rate of inflation. The first bar on the left shows if inflation was at a rate of 0%, the annual income of the portfolio would grow by 2.5% per annum. If inflation per year is 2%, as per the third bar from the left, the annual rental growth would be 3.5% a year. So when there are lower rates of inflation, the income growth at the top of the bars, the portfolio should grow faster than the inflation at the bottom of the bars. Anything up to a CPI of 4%, the rental growth outperforms inflation. Anything over the 4%, the caps and the collars within the leases kick in. Rent increases. We've touched on this slightly before. So rent increases since March. We've had 13 rent reviews completed so far with a £500,000 uplift, which is an increase of just over 11% on their current rents passing, which is now works out as an average increase of 3.3% per year per review. There are 4 rent increases left this financial year to March 26, with a forecasted £400,000 increase. All 4 have 5-yearly review patterns. 3 have an RPI and 1 have a CPI review. So for the financial year to March 26, 67% of the rents, representing 6.5 million, will have been reviewed, and that's 17 tenancies.
So these pie charts are from our interim report, but they show how well diversified we are on capital value percentage by region and by sector, and we include Scotland. And this chart shows our top 10 properties by capital value, just a summary sheet. So how do we outperform?
So active stock recycling and improvement. To outperform, we continuously renew, refresh and reposition our portfolios. Over the 5 years to end of June 25, at Olim, across all the portfolios we manage, we bought 39 properties for 215 million and sold 104 properties for 447 million, disposing of all of our shops and restaurants, increasing our holdings of industrials, supermarkets, and a whole variety of investments in other alternative sectors, such as garden centres and health clubs.
We do outperform over many years by a combination, if you like, of whether you want to call it macro, micro, or top down and bottom up. We form significant views about the direction of the market and interest rates, but at the same time, we are very, very hands-on with our individual management. So we start off, the base is always to have strong tenants on long indexing leases. And we also, from long experience, have had no offices, and we try very hard to have no voids. Offices, basically, ever since I've been in the business, have been underperforming most of the time, basically because the market consistently underassesses the amount of depreciation needed. You start with a bright, shiny office, like a bright, shiny new car, and very quickly you haven't got what you started with.
So all our properties, as I said before, are 100% EPC compliant, and they're all let on full repairing and insuring leases, so that the tenants are responsible for their upkeep and repair, and there are no financial liabilities to the landlord at lease expiry. Our properties are realistically valued and ready for sale. We have quarterly RICS Red Book valuations, and our solicitors hold all the property deeds and information together, ready to go when we decide to sell. And with small lot sizes, they are not illiquid assets. Obviously, we've sold 4 recently at valuation and have proven that they can be quickly disposed of.
It is, though, key when you're running a long index-linked portfolio over many years to make sure that the rents are sustainable and repeatable, if you like, particularly if anything were to happen to the tenant. We are very careful about our covenant analysis when we buy properties, but obviously over a period things can change, markets can change. For instance, we did have a lot of Stonegate pubs at one time. We were very happy with how it was being run, but they overexpanded and the rents got too high, so we decided to come out completely from that. We are quite decisive when we think risk has built up in a portfolio or if rents have got too high.
5 today completions. So at Olim, speed of purchases and sales compared to competitors is key. We perform quickly on both single investment properties, portfolios, and sale and leasebacks ranging from 1 million to 50 million, often completing in 5 days. We aim to purchase within those 5 working days from first being offered the deal, with solicitors being instructed. We haven't gone to inspect the property to complete the legal documentation. And for sales, we aim to exchange 10 to 15 days after solicitors have been instructed. Hands-on, fully discretionary mandates. As fund managers for all our portfolios, we add value by stock selection and our unique way of buying and selling. We don't have a long-winded process having to go back to boards for approval like the majority of our competitors. Trusted property sources all over the UK. We source stock through our national network of around 150 agents who we are in regular contact with, who are aware of the type of stock that we are looking for. We preferably like to buy off-market and off-distressed sellers. We see an exceptional flow of investments before our competitors, both direct from property owners and through our agents, needing certainty and speed and reliability. Sector changes over the years. This graph shows how we've moved out of sectors as markets, economic situations change, or selling before the market spots covenant weakness, as we did with Prezzo restaurants and Stonegate pubs. We are constant recyclers, improving the quality of the portfolio. We're sector agnostic. Due to our strategic sales programme, we are no longer invested in the high street, with our last shop sold in January 2020, which was a WH Smith in Godalming. In 2014, we had around 40% in the high street. Supermarket holdings have increased from 5% in 2014 to today being over 30%. Industrials have increased from 8% to 20%. The portfolio reached a weighting of 33% in 2022, and we've since decreased our holding slightly within the sector as the market is overheated. Pubs and restaurants. In 2020, we had 32%, with several Stonegates and Prezzos as mentioned, and we sold them all, so the sector weighting is now down to 3% in pubs. 2 pubs let to Shepherd Neame. We haven't bought any pubs in the last 5 years, but sold 10 during this period. Offices, we don't do offices as mentioned before. Roadside, we've been in and out of the sector, currently out. Alternatives have increased to 45%, which now include a health club, caravan park, bowling alleys, hotels, and a garden centre.
Yeah, we're sector agnostic, but we're definitely atheists on offices.
VIP stock recycling since 2020. So 28 properties within this portfolio have sold for 58 million with an average lot size of 2 million. And the purchases, 27 properties for 129 million with an average lot size being increased to 5 million. We focused on tenant strength, lease length, and the weighted average lease length is now over 13 years to the first break, indexation, and we look at strong EPC ratings. The portfolio's defensive characteristics provide stability during market volatility. And whilst other REITs have to firefight, such as reducing their void rates, we can concentrate on improving the portfolio by buying and selling.
We thought it helpful if we run through a couple of case study examples. So this is our first one. This is our Premier Inn hotel in Catterick in North Yorkshire. And this is a good example of how our active investment management unlocks value. We bought this property during COVID, and it's near to the largest British Army garrison, and which has passing out ceremonies every Friday. So during COVID, the hotel was 100% occupied, and it's still over 90% occupied all year round. Whitbread have been turning underperforming hotel restaurants into additional bedrooms, and they came to us asking for us to help fund conversion of their restaurant to add an additional 15 rooms. We offered them around £300,000, which is about 8.5 months rent free. And in return, they removed the break option they had in 2035, and we added an additional 10 years to the lease. So as a result, the valuation has gone up 17% from 6 million to 7 million. And we thought it helpful to run through our most recent purchase and our largest asset by capital value. This garden centre is in southern Cheshire. We bought this in August 24 for a net initial yield of 6.6%. It's on a 37-acre site and is let to Blue Diamonds, the UK's leading garden centre operator, until 2049, with 5-yearly RPI-linked rent reviews. The next rent review is next month, and the yield will rise to 7.8%, which it's now valued at 17.5 million, and it's at a 6% increase in value. We track other property funds and competitors very closely, and we bought this off market from St James's Place, who were clearly struggling at the time.
On the property side, anyway.
Yeah.
I'll keep this one short and sweet. Last month, we completed a defensive lease extension at this industrial unit in Milton Keynes, adding an extra 10 years to the lease term.
Right. As an investment trust, or now a REIT, we have always been able to and wanted to use debt to increase returns in a carefully managed fixed rate way. Our long-term borrowings now are at 4.5% fixed. We felt that interest rates were unsustainably low 3 or 4 years ago, so we locked in a very realistic rate of 4.5% until 2033. We do move the debt ratio up and down a certain amount as to over the cycle. At the moment, we are cautious and that we are 33%, which is towards the lower end of the debt range that we normally work with. We also took out, as Sarah has mentioned, a sort of precautionary, if you like, revolving credit facility. So the ability, it's like an overdraft facility, really, the ability to draw 15 million if we wanted. That was in order to fund a possible take up in the tender offer, which was actually very few people did take it up. So that has not been drawn, but we have that available if the right opportunities come along to invest at higher yields in property. So we are basically have all our current debt is fixed for 7.5 years at 4.5%. The tender offer I touched on, that was an important milestone for us. When we changed during COVID from being a part equity and part property trust, because that was the only way we could have kept the dividend going, because equity dividends were being slashed to ribbons, but in fact all our property rents went on being paid. So when we did that, we said at the same time that shareholders would have the opportunity in 5 years' time from then to take out their money if net asset value less costs if they weren't happy with the change. Now, this was recently completed, and only 3.3% of shareholders wish to take up the cash offer. So we are very grateful to all our shareholders, some of you I hope here today, for your support. And we clearly now have very loyal, long-standing individual shareholders focused very much on our dividend growth record, which we're determined to maintain. Just a little slide here. Basically, apart from myself, my family interests, which has been built up steadily over many years, and my charity, apart from that, all our shareholders, we have many individual small shareholders. You can just see here that the main change in ownership in the way it's reported has been an increase in the amount of shares held by the platforms. So that's people like AJ Bell, Hargreaves Lansdown, Interactive Investor over the last few years. But we think basically those are still private investors who find it convenient to hold their shares that way.
So we've prepared a slide for why invest in VIP, which I will leave up. Otherwise, that concludes our presentation, and we're happy to take questions.
Perfect, guys. If I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, as you can see there, we have received a number of questions throughout your presentation, and thank you to all of those on the call for taking the time to submit their questions. But Sarah, at this point, if I may just hand over to you to chair the Q&A, and if I pick up from you at the end, that'd be great. Thank you.
Okay. Thank you. Okay, we've had quite a few questions, so I'll group some of them together. The first one is, could you explain the investment rationale for the caravan park and the pubs, and what are the attractions and what are the risks?
Okay, I'll give that one a go. The caravan parks and the two pubs were sale and leasebacks on good terms to companies who needed the money at the time. The caravan park was purchased 26 years ago and the two pubs 16 years ago. The attractions here are that they're let with long RPI linked leases. Specifically the 28-acre site in Dover has good rail links and alternative use, and has annual RPI increases with a minimum of 3% and a maximum of 7% a year. And every 5 years here, the rent is increased to a higher of RPI or 14% of turnover. And the actual average annual total return since purchase at Dover has been over 30% a year. And the two pubs are let to Shepherd and Neame, who are Britain's oldest brewer, apparently, from the 16th century. So we're hoping nothing actually happens to them. They've got 24 years left on their lease. They have 5-yearly RPI uncapped rent reviews with a minimum increase of 15%. And the average annual turnover on both pubs is around 15%.
Total return,
is 15% a year. So, and hopefully if anything did happen to them, we wouldn't have a problem in reletting the two pubs.
Okay. There's a couple of questions about debt, which I'll ask Matthew to answer, and I'll group them together. So what is your philosophy around managing the average loan maturity? Your refinancing a few years ago looks fortuitous in hindsight. Would you mind elaborating on your thinking? And is your debt secured or unsecured, and why?
Well, I covered a little bit of this in my presentation, my remarks in the presentation, but we've always matched our long, strong indexed debt with a long, strong index income with fixed rate debt as far as we can. And were we fortuitous a few years ago? Well, I think we took a view that interest rates were too low, and we definitely did decide to fix it. And now we're happy we've got that debt locked in. And as I mentioned, we also have a flexible but undrawn revolving credit facility for 15 million. We borrow secured. It's a lot cheaper, certainly for anyone our size, but even if you're very big, secured debt is cheaper. And the sort of properties we have, banks are very happy to lend on. It's very secure covenant, very secure stock for them, and we want to borrow as cheaply as we can.
Okay, thank you. And there's a question. I like the table in your interim report comparing property yields to index-linked gilts, and equity yields. Would you mind elaborating on this framework and how you use it to assess value? So the main commercial property market uses the 10-year conventional gilt rate to assess value, and that's currently running at about 4.5%. When the long-term interest rates increased rapidly in 21-22, this puts a lot of pressure on the commercial property market and values fell. So as 100% of our income is index related, we refer to the 10-year index linked gilt rate, which is currently about 1.6, 1.7%. So our running yield is 6.5%, which is 5 points above the index linked gilt rate. So this makes our portfolio look good value. Okay, and then we have a two-part question about the tender offer and share buybacks. So it's about the reasoning behind the tender offer, and then why we were buying back shares with little or no benefit to shareholders.
Right. Well, I covered, I think, why we had promised to do the tender offer, and we went through with that as we said. We had to do that in order to give people the opportunity to, realise all or a substantial part of their shareholdings, as we promised. In fact, anyone who did want to was able to realise the whole of their shareholding. The buybacks, we did just a few the other day, because we now have only 7,000. We now have a policy which we've stated as part of the tender offer that we will have an active discount control policy, and will buy back shares at a 10% discount to avoid people being caught with a big discount. Now, in last year, though, in the year ended March, which we're talking about, we did have quite a bit of buying back. We bought back 651,000 shares at 180p on average, which was a 15% discount to net asset value. So that did add a worthwhile amount to the net asset value. And it also did help the revenue account, because if you're buying back shares as we were on average yield of about 7.5%, effectively you're saving paying that dividend. But in addition to that, also, if you buy back shares, you're shrinking the portfolio a bit, so you're actually saving the investment management costs paid to Olim on that amount of money. So the effective yield you get on the buyback is about 8.5%. So you can see that does help value as well. We don't want to necessarily do vast amounts of buying back, but certainly last year it certainly was accretive to asset value and the revenue account, and I think it does help underpin the share price.
Okay, we've got a few more coming. So why has the life of the company been fixed to expire on March 31st, 2033? Does that coincide with management's retirement plans?
No, I don't think any of us here have retirement plans. I don't think I would want to definitely retire before I was 93, but we've got no particular plans. But it just is. We felt it was important in terms of giving shareholders the security to carry on and support us as they have, 97%, that there would be effectively an exit in 7 years' time, but also that coincides with the expiry of our cheap fixed rate debt. So we felt that was something which gave a reasonable period for people to invest, for us to build a portfolio and the portfolio to grow. We thought that was a fair compromise, and I think it's been successful in the sense that nearly all our shareholders were happy to carry on that basis.
Okay. And there's one, can you comment on the dividend being uncovered by earnings per share and how the progressive dividend will be funded going forward?
Yeah, it has been tight. We have still, it's been quite hard work to get the dividend. We were almost covered last year, but not quite, where we had this big change from being equities and having to buy a lot of property and have quite a lot of dealing costs. This year, the dividend will not be covered because we are In transition, we've had quite a lot of extra costs, both with changing to a REIT and obviously then the cost of the tender offer. But we are forecasting and expecting that the dividend will be covered from next year going forward. That's 2026-7, and that's our forecast and our expectation. And we do want to be paying cover dividends. You'll see, as Louisa said, we've had a lot of rental growth this year, and we are hopeful we'll get back to full cover, as we always were for many years before the change next year.
Okay. We have, why do you not have a dividend reinvestment option? I don't think anyone's asked us that before, but I think the administration costs would be prohibitive for an investment trust of this size. Another question is, with the portfolio now largely RPI linked and long leases, what does the next 5 to 10 years look like for VIP in terms of growth? Where do you see the most realistic opportunity to increase shareholder value from here? Yeah.
We have 10 rent reviews, 2026 to 27, and 27 to 28. At the moment, we have 9 rent increases, and we will hopefully be buying more in that period as well.
Mm-hmm.
Yeah, I mean, we have, we've always been quite active round the cycle. We think property yields, certainly index-linked property yields, are attractive at the moment, but the market is quite thin, so we don't want to buy for the sake of it. But we have been quite good at finding, as Louise said, distressed sellers in the past, so we're very much on the hunt for them at the moment. We hope we're just working on quite an attractive buy at quite a high yield, hoping there aren't any snags in that. And we will move around the different sectors. And so on top of this base, we will be trying to add value. And we're also quite opportunistic. If we want to grow, we have got the tender behind us. We are quite small, but we have a very, very good record. And there's quite a lot of change going on in the sector, and we have been approached in the past by people to take over other companies. We're certainly open to creative opportunities as well.
Okay. There's a couple of questions about the share price. One viewer is saying the current share price is currently at the same level as it was 2 years ago. Could you help me to understand why?
Well, they do fluctuate. The property market's done nothing for the last couple of years. I don't know. I mean, the share price, the effective share price, the share price that really mattered was 204, which people could sell at. I mean, it is quite a thin market, so it might. I don't know if it's 195. Its price is 195 or 192 or £2 today, but it's around that level. It certainly has generally been improving over the last couple of years, and the discount's been narrowing. But at any one point in time, with a 10p spread, it can be 5% higher or lower. But in general, total return is our target. There's been a good yield over the last 2 years as well, and a large proportion of the very strong total return we've had over many years. The outperformance we get is because we're getting better income and better income growth than other people within that portfolio, and the total and no voids. And the same thing applies when you've had the sort of income growth we've had. The capital will fluctuate a bit, but no, we think it's the total return has been pretty satisfactory actually.
Mm-hmm. And there's 2 questions on the portfolio. One is, how do you decide which client gets which property acquired and avoid conflicts of interest? Mm-hmm. And the other is, with 82% of contracted rent with top 10 tenants, are there internal limits for exposure to any one tenant?
Well, shall I say yes? We wouldn't have. I think we have. Is it 25? I think we have in our thing we're 25%, except for the government. But we do have 25% as a limit. But it depends. We wouldn't normally have more than say 20, but it just depends what the opportunities are, because it's quite a small portfolio, and we have done deals with Marks and Spencers before. We would be quite happy to go up to 25% with the strong tenants.
Mm-hmm.
Who wants to talk about how we allocate properties?
Yep. Well, conflict of interest policy, we obviously have one with all of our clients, and they vary in different sizes. We have a fund over 400 million, and we have a fund down to 20 odd million. So they have different requirements. We will look at who actually has a tenant. For example, Marks and Spencer's, we will look across all the portfolios to see who has a supermarket at Marks and Spencer's, what regions. Some might be top heavy already in Scotland, so we decide, no, we won't go there. So we go through every sector specific, who's got already got a holding and who's actually got cash, whereas all the funds that we've got at the moment might not be able to buy at the moment.
Yeah. We very rarely find there is a question mark. Basically, I mean, we start off with who actually has cash to invest, because, I mean, at the moment, we've got, what, seven portfolios. VIP is actively seeking to invest. We probably only have 2 other funds that are actively seeking to invest. So that narrows it straight down. Then, as Louise says, you've got big ones and small ones, so the lot size. So it's very rare. And on the other side, if we were just running VIP with 130 million, we wouldn't see anything like the deal flow that we do, because we are very, very big players in our selected markets. I mean, we own a lot of pubs still. The fact we haven't bought any, it doesn't mean that we're not big players in that. We're probably the most active players in the market in bowling alleys. We're very active in garden centres. That VIP and each other client gets the benefit of the fact that although we're quite small, we're not that small, but we're probably the largest owner-managed property investment manager in the country. But, you know, we are in the sectors we play in. We do see the deal flow. We do see all the stock. And in practice, we have not ever had a conflict of interest. To buy. But we, of course, it's all monitored very carefully. We report very carefully. And we don't have to be regulated by the Financial Conduct Authority, but we choose to be that. So to give reassurance to all our clients.
Okay, and there's one final question, is again on the shares. Why have VIP shares traded at a persistent discount when the shares of another small rival are trading at close to par?
I don't know which one you're thinking about.
AEW REIT. Yeah.
Well, I mean, you can look at been a persistent discount, but not a very big discount, VIP recently, and that's part of the reason. You see, all the shareholders, if you were a shareholder, you know, they had the opportunity, if you wanted, to sell out at a 5% discount, and people didn't. And we are going to make sure it doesn't attend. AEW REIT is interesting. We like them. They're interesting people. They're very aggressive dealers, and they pay a very high yield. Not always very sustainably covered, but we respect them. But they are in a riskier end of the market. But you can look at, if you look at other REITs, if you look at the general run of REITs of our size, or even bigger, our discount is a lot narrower on average than comparable REITs. So you can always pick out one, and AEW REIT is, as I say, they pay a very high yield and they're good at what they do. But in terms of overall, our discount is really quite tight.
Okay, that's all the questions now.
Perfect. Perfect, guys. If I may just jump back in there, and thank you very much indeed for being so generous of your time there and addressing all of those questions that came in for investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended. But Sarah, perhaps before really now, just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company. If I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Just to say thank you very much for taking time out of your day to listen to our first Investor Meet presentation, and hopefully see you next time.
Thank you.
Thank you.
Perfect, guys. That's great. And thank you all once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the Value and Index Property Income Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.